From New York City for our audience worldwide, I'm Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, is it or isn't it QE? That is the question for the Federal Reserve. As risk assets rally, CCC borrowing costs drop below 10% and the global economy shows further signs of stabilising. We begin with the big issue. One question for the Federal Reserve.
Does this count as QE or not?
The Fed continues to tell us this is not QE.
The market seems to believe it is.
The market believes it's QE.
Which is all that matters.
Think about what the Fed's told us.
They're expanding their balance sheet.
They're going to continue to do balance sheet expansion.
The market is taking this as a signal.
That kind of liquidity is going to be really hard to fight.
That's actually putting the Fed in a bit of a bind.
It creates the risk of a policy mistake.
The Fed's not going to make a policy mistake.
If everything is fine,
if the data just doesn't get worse,
which is what people are forecasting,
you could have a second half where the economy is bouncing back.
The second half, we should see that fade.
I think the Fed is actually going to surprise a little bit to the downside on the balance sheet.
They shouldn't continue that kind of balance sheet expansion.
Is the market going to see that as, the end of QE or quantitative tightening?
Well, the Fed playbook is to cut big and cut fast and signal QE very quickly if there is weakness.
I think that's a big risk for the market somewhere closer to the second half of the year.
Joining me around the table here in New York is Greg Staples of DWS, Lisa Hornby of Schroders and Ken Monaghan of Amundi. Let's talk about it, shall we, Ken? Your thoughts on that. Is it or isn't it QE? Weigh in on that debate, please.
Well, I know Mr. Kashkari is trying to throw cold water on the idea that it's not, but I'm not sure even being in Minneapolis, he's got enough cold water to throw to convince the market that it's not. I think the market's call is correct on this.
Why do you think the market's call is correct on this?
Well, I get his point, which is that they're just substituting one short-term instrument for another that's risk-free. But the way the market's looking at this is providing more liquidity, and that liquidity to the market is obviously driving prices higher for risk assets.
Well, let's take that tweet from Neil Kashkari and put it on the screen, shall we? Neil Kashkari, the Minneapolis Fed president, writing the following. QE conspiracists can say this is all about balance sheet growth. Someone explain how swapping one short-term risk-free instrument, reserves, for another short-term risk-free instrument, T-bills, leads to equity repricing. I don't see it. Lisa Hornby.
I think you just have to look at the market and say, look, it doesn't matter whether you believe it or not. Markets have reacted to years and years of liquidity being poured in by central banks around the world, and this is another example of it. Whether Neil Kashkari wants to say it's true or not, I think that the market has spoken for itself. We're at equity all-time highs. I mean, once again, bonds can't even sell off a few basis points, and we're at all-time highs on the equity market.
Chairman's Powell argument would be if there's no forward guidance, it's not QE, but unfortunately the perception of the market is the reality, and the real question will become in February is let some of that term repo roll off. Do we reverse in the markets?
Is that the ultimate point here? Perception matters. So long as enough people think it is, that's all that matters right now. Is that where we're at?
I think that's where we're at right now. It's setting the tone of the markets for all of 2020. We're coming off a great 2019. This is setting the tone for 2020.
You agree with this, Ken?
Look, it's like watching the Fed dots, okay? The Fed dots may be in a very different place than where the market is. And I think that the market's judgment's correct. The Fed may be saying one thing and may be trying to guide in a certain way, but the market's taking its actions completely differently.
One crack in the resolve of the Federal Reserve this week, and it came from the Dallas Fed President Robert Kaplan speaking in an exclusive interview here at Bloomberg. Take a listen to what he had to say.
There's three aspects. There's one, rates are lower. Then there's a perception that the bar is higher for future rate increases. And then the third issue is in order to address this repo issue, we've grown the balance sheet. All three of those actions are contributing to elevated risk asset valuations. And I think we ought to be sensitive to that at the FOMC, and I certainly am.
Lisa, here's the issue for me at the moment. This audience for this programme, incredibly sophisticated, and I imagine a large proportion of it will take the view of Neil Kashkari. Is there a risk, though, of being too smart about this problem right now, if we can call it a problem, and the read-through from what the Fed is doing into broader financial markets?
I mean, I think the risk is that markets have become accustomed to this liquidity, and whenever the Fed tries to pull it away, they create problems. I mean, we saw that at the end of 2018 and the beginning of last year, they literally had to reverse the hiking cycle. I mean, at the end of the day, growth didn't change that much. Yes, we had fiscal stimulus-induced strength in 2018, and certainly it came off in 2019, but we're still at 2% growth rate. So it wasn't necessarily a growth problem, it was a markets problem. And I think the Risk Bank has alluded to this. Monetary policy cannot solve all ills of the market, and that's why they're beginning to pull back. I mean, we are conditioned now to believe central banks will solve everything. We only have 175 basis points of rate cuts to go in the U.S. before we're at zero. So they have to be very careful in the messaging, but equally, whenever they try to pull back, markets react very negatively, and then they're forced back in.
We've been conditioned by these central banks who are doing this. And Ken, I think that's worth exploring, that maybe the Federal Reserve's missing the broader picture here. There's a huge green light on to take risk in financial markets. And the Federal Reserve is shining that ever brighter. Effectively, the message they've sent is that the economy this year is okay, the economy is in a good place, and even if it gets better, we're not pulling back. But if it gets worse, we'll step back in. We'll be ready to do even more. We're going to spend a lot of time talking about credit and perhaps the risk, talking about credit in, say, triple Cs, leveraged loans a little bit later in the programme. But at the moment, is that the broader picture that you think the Fed might be missing at the moment? That they're flashing a massive green light to say, load up on risk?
I think that's exactly what they're doing. That may not be the intended message, but I think that's exactly the message the market's taking away from it. The Fed's going to have a very, very difficult time weeding the markets off this concept of they're going to be constantly stimulative. I don't know how they're going to get that done.
Greg?
I'm not sure there's a better policy. You might be arguing that they're making a policy mistake by being too soft, too dovish. But what would be the alternative? As we've pointed out, Lisa pointed out, if they are a little more hawkish, the markets react very, very negatively.
Well, I don't want to spend too much time talking about what the Fed should or shouldn't do. I just want to talk about what it means for capital markets. You mentioned treasuries. Yields have hardly moved. 180 on a US 10-year. Even though credit has rallied really quite nicely, equities ripped over the last 12 months, and here we are, 180. Why?
I mean, honestly, if you had asked me a couple of weeks ago, I'd say that we probably should be a little bit higher in yield, not aggressively so, but obviously this tells us something about positioning and demand for treasuries and U.S. fixed income. It's still out there. And, I think that tells you we're probably, the sell-off, if there is one, it's going to be very muted. It's going to be bought.
Ken?
I think treasuries are run about as far as they're going to run at this point. I do think that if we do see some improvement in growth, we're looking for improvement in growth in Europe, for example, that the message will be the market's going to be adjusting for that at some point. Are we going to go dramatically higher? No, but I think we're probably at the low end of the range.
Don't you think we're getting that already? It's almost like Chinese water torture on the top of a treasury at the moment. Just drip, drip, drip of OK data from the United States. Housing starts ripping to close out this week. Chinese data doing OK. That Chinese data to close out the week was really quite terrific compared to what we had 12 months ago. Here we are, yields up by what? A basis point?
Right.
Does that make sense?
I would argue it should have moved more, but there's obviously this tremendous damper on the system that's the Fed, and I think that's what you're seeing right now.
Greg Staples?
ECB is still supporting with 20 billion of euros in their version of QE. That's supporting it on one end. Seems like the market consensus is the Fed's completely out for all of 2020. That leaves you with a 10-year at 180. Break evens, 175, real yields, 5-10 basis points.
Yeah.
I don't see anything breaking us out of here.
We've got to talk about the Treasury getting back in as well. A 20-year issue coming to market. My question quite clearly is whether the average duration is looking to be pushed out here by the Treasury lease or whether they just take some out of the 30, put it into the 20, rob some from elsewhere as well. How do you see that evolving in the coming year, the average duration of the Treasury?
So, first of all, I think it would be smart for them to increase the duration given how relatively flat and low yields are. In the near term, they might try to do some tweaks because they don't need the funding this year, but they need the funding next year. So whatever they do this year, I think will be temporary, just to try and get the issue well absorbed. I think next year we'll see normal auction sizes in the 20-year. I think this will be a consistent part of the curve for as long as we're in markets.
Was that a signal then for a steeper curve from the Treasury?
I believe 100% it was. I mean, I've been on the show talking about this very topic. They should have done 20 years. I think they could even do longer debt at some point. It will be bought. There's clearly demand. There's no question about that. But I do believe that the Treasury and the Fed and central banks truly around the world want steeper curves. They realize what happens when the market gets itself into an inverted curve cycle and how bad that is for growth and future prospects. So I think that they are doing everything they can. Buying bills is one way to steepen the curve. Issuing 20 years is another way to steepen the curve. These are all slight tweaks at the margin, but they need the funding. Curves are flat. Why not?
Greg Staples?
There is demand for it. You talk about LDI, the liability-driven investments, long insurance companies. I think it's going to be very well accepted within the marketplace. And when the Treasury sees that, there'll be more issuance there.
Final word, Ken.
Go long.
Go long a steeper curve?
Yeah.
that it? Short and sweet?
That's short and sweet on that one.
All right. A little bit more from Ken a little bit later. Coming up on the programme, the auction block, the relentless bid for European debt raging on with another record-breaking week of sales. That's coming up next. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. I'd like to head to the auction block now and kick things off over in Europe, on the continent where the primary market has a record month in sight, needing sales of just another 50 billion euros to top the January high. Unprecedented demand for sovereign debt in Italy and Spain, the two receiving record orders of 58, 48 and 53 billion euros for their 10 and 30-year offerings. And in the United States, the persistent bid for investment-grade debt continuing. High-grade sales of $35 billion, topping projections with Thursday's deals more than 2 times oversubscribed. Sticking with credit, some investors growing increasingly cautious following a stellar year of returns. KKR cutting its weakest investment-grade debt, BBB, to underweight, writing the following: the macroeconomic and geopolitical environment, including heightened regulation, could trigger a wave of fallen angels or investment-grade credit falling back into the high-yield category over the next 12 to 18 months. Colin Martin of Charles Schwab just pushing back a little bit.
With more than half of the market comprised of triple Bs, there's really not a stigma anymore, right? They're okay with that. So I think they believe they have the tools to defend that if need be. And with yields so low everywhere, they're okay with triple Bs. Through the years, if you've been an investment grade corporate bond investor, you think that's a high quality investment, over time, it's gotten riskier. Still investment grade, but you're taking on more and more risk today than you were 10, 20, 30 years ago.
Let's get the thoughts of the guys, shall we? Greg Staples, Lisa Hornby, Ken Monaghan still with me. So, Ken, let's talk about it. In credit, in triple Bs at the moment. The story coming into 19, the narrative that slowly builds is that the C-suite could defend their credit rating. Do you think they still can?
I do. You know, in 2019, we saw something for the first time in my 30-year-plus career. We saw AT&T, one of those issuers that's on the cusp that people have been concerned about, being downgraded to below triple B to high yield. Its board of directors put in something into its management compensation scheme where management's being judged partly on its ability to keep debt below a certain level. The reason for that is the board is quite cognizant of the fact that a reduction in rating for AT&T into high yield would kill that stock. So the board's done something to protect itself. And I think you're going to see more and more of that. Now, are they going to be no fallen angels whatsoever in 2020? No. But I can't. There will be a number of them. But the result's going to be as dire as some of the prognosticators are predicting, like our friends at KKR. I don't think so. I think it's an overly conservative call.
The reason I find this KKR call slightly more compelling, just looking at the detail from Henry McVeigh, is the call on policy, and to point out that within investment grade, within triple Bs, healthcare and energy make up a decent slice of the pie. You're exposed to a change in policy. And if the long trade last year was about being long what you're talking about, the C-suite getting their hands around some issues, in healthcare and energy, you're exposed to things you can't control, a policy change. And the argument essentially being, as the year grows older this year and the politics come into sharper focus, particularly on the left, Lisa, whether that's going to be a problem for this credit market.
You know, I'm cautious on credit. You look at overall valuations, you have to be more cautious. You're playing for a handful of basis points at this point. It's not like where we started the year 1 year ago. But I do think, to Ken's point, there are opportunities in certain triple Bs. I mean, AT&T is a great example. There's a number of other ones where you can cite, look, they're doing the right things in terms of deleveraging. In fact, we actually saw payout ratios in triple Bs come down last year, so they're paying out less to shareholders, whereas single A rated companies are paying out more to shareholders. So they're going in opposite directions, which means there are some opportunities out there. Certainly there could be policy changes, and that's something we're cognizant of, especially as we go throughout this year in a presidential election. I mean, really what you have to think about, though, is not the presidential part of the election, it's really Congress, right? Because you have to, if the Democrats were to win the White House, you really have to have a call that the Democrats are going to win the Senate as well, which seems less likely to us at this juncture, for them to get meaningful policy change done that would really materially impact some of these sectors you're mentioning.
Greg?
Triple Bs are now trading, what, 1-teens? This is where single As were trading a year ago, so we've done a complete reset there. But high yield has gone in 200 basis points, and single A's have come in 45. Everything's tightened. I think, and triple B minuses are only a quarter of that market. They're only 25% of the triple B marketplace. Are there subsectors within there that are going to be at risk? Absolutely, but to broad brush the entire triple B marketplace and say that's all at risk, I don't think so.
The triple C's right now, south of 10%. Some big calls came in at the back end of last year to start rotating to the junkiest of junk in December. PGIM were one of the houses out there that did that. It's paid off fantastically. Big rally through December, nice follow through into 2020. What should you do now, especially if you made that rotation? This is Kathy Jones at Charles Schwab weighing in.
We don't like the triple C area. And the reason is that you have to have this constant flow of liquidity and turnover in refinancing in those companies. So anything that, after the big rally, anything that gets in the way of that could cause some real problems in the sector.
Ken, your thoughts? Big rally, what now?
You have seen a big rally, and obviously you had an enormous lag up until December, and then Triple C's rallied dramatically in December, and they've continued that rally, outpacing the rest of high yield so far this year. Having said that, I think, again, this is an overly conservative prediction. You need to recognize that if you look at the Triple C market in particular, there's a large portion that's energy related, and she's correct. A large number of those companies need to have access to the capital markets in order to survive. But within the Triple B space, there's also an enormous number of companies that have very specific idiosyncratic risk. And you need to look at those individually rather than just saying, okay, all Triple Cs have too much risk or too much refinancing risk, we're going to ignore them.
You know what the joke is, though? Everyone always thinks they hold the good ones. That's always the joke, isn't it? I've got the good ones. It's going to be okay, and I'll get out when I need to get out. Isn't there a big liquidity risk here, Ken?
Well, that's a broader question as it relates to the high yield market and the corporate credit market in general, as to whether or not we could be in a position at some stage where there would be liquidity risk. And we're mindful that you need to manage your liquidity in your portfolio.
Well, let's think about it, Ken. We've sat around this table. Everyone around me has said that this is QE. People screaming at the TV saying it's not, but you guys think it is, so let's go with that.
Right.
If the Fed backs away from its balance sheet in a couple of months, halfway through the year, and you're sitting on a triple C credit and this market starts to tighten up, or rather spreads start to blow out, it's not a good place to be, is it?
Well, if you're assuming you own a triple C that has to have access to the capital markets.
Well, I guess my question is, can you simultaneously say that this rally is built on a balance sheet expansion at the Fed because this looks like QE, and have the confidence to sit in the riskiest parts of credit, when what you're effectively telling me is that this rally is built on Federal Reserve stimulus and pretty much nothing else? Can you simultaneously have that trade on? If your framework for this market is this is a QE trade, and the Fed's telling you it's not QE, and there's a real risk that because they don't think it is, this balance sheet expansion ends at some point this year, do you really want to be sitting on those credits?
Well, I think the answer to that question is you're right. The Fed is supporting the broad rally that's taken place in the marketplace. But that doesn't mean that I can't select. And granted, you always think as a portfolio manager, you're selecting only the best ones and ignoring the ones that are not. But we are very focused and confident in our credit selection skills. I look at what propelled us forward in terms of returns last year.
Yeah.
It all came from credit selection.
Well, I don't want to question your homework. I don't want to question anyone's homework around this table. But if you guys had made the argument to me that this rally was built on fundamentals, on better fundamentals, and that you wanted to own the riskiest of risk, loans, triple Cs, you name it, whatever, because it was built on better fundamentals and we're underappreciating what would happen this year as the year grew older, I'd sit here and say, you know what, that makes sense. But if you're telling me this rally is built on QE and balance sheet expansion, I just struggle to get my hands around that.
But aren't we seeing some improvement elsewhere? Aren't we seeing some improvement or evidence of it in Europe, for example? Aren't we seeing some evidence that there is improvement in China, for example?
Yeah.
Wouldn't we expect that exports will be potentially increasing as well? So I think that there are some things beyond the Fed holding this all together.
The guys will be sticking with me. Still ahead, the final spread, the week ahead, featuring a slew of central bank rate decisions. That conversation is coming up next. This is Bloomberg Real Yield. From New York City for our audience worldwide, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Looking up over the next week, a lot of things happening, including the kickoff of Davos, the World Economic Forum over in Switzerland, some central bank decisions in the mix, and some PMIs as well. Lisa, let's talk about it. The following week, ECB next Thursday. What are you looking for?
Not a whole lot, to be honest. I think it's going to be pretty dull. I think that Lagarde is kind of coming in there with this notion that fiscal needs to take over. Monetary has done as much as it can do. I don't think markets are expecting very much, to be honest, and I can't really disagree with that.
Greg Staples?
I think absolutely the ECB is going to be a snooze. The real question is, does the BOE do something?
Yeah.
BOE set to cut. By the looks of things, that's a real live meeting at the end of this month. But on the ECB, Ken, do you think the pressure's building on President Christine Lagarde quite early in her tenure to defend where monetary policy is right now, to defend the concept of negative interest rates?
I think she got a fair amount of support as Super Mario left the picture and made it clear that that the policy that the ECB has followed has been the right one. But he also brought up the message, which is we can only do so much lifting. And really what needs to happen next is fiscal side of things. And really we have not seen that. And we got to get Germany to get off the dime on that and make moves in the right direction.
Do you think that's going to happen anytime soon?
I don't think so.
Elisa?
It doesn't look like it at the moment. I think things have to get significantly worse before we see some real move on the fiscal side.
Seems to be the take, doesn't it?
I've got strong, obviously, connections within Germany, and the consensus there is it ain't going to happen.
Just not moving. Some people on this side of the Atlantic think it is going to happen.
No, not going to happen.
Not going to happen. That seems to be the consensus at the moment. Guys, let's get to the rapid fire round, shall we? 3 quick questions, 3 quick answers if we can. Let's get them into the boxes. First question, is it QE or isn't it QE? I know where you all stand on this now. QE or not QE? Lisa Hornby.
QE.
Greg Staples.
Perception's reality, QE.
Ken Monaghan.
It's QE.
20-year issuance coming out of the Treasury this year, a 20-year security out of the Treasury. Does it lead to a steeper yield curve? Yes or no? Steeper yield curve, yes or no? Greg?
Yes.
Lisa?
Yes.
Ken?
Echo the sentiment, yes.
Third and final question for you all. Big rally in high yield through last year, spilling over to triple C's now from December really into 2020. Do you stick with the triple C rally? This is a massive question for anyone that's rotated into triple C's, particularly if they caught the wave back at the start of December. Do you stick with triple C's or do you start to fade the rally of the last couple of months? Stick with it or fade it? Greg?
I very much would fade it.
Ken?
Stick with it for the first half of the year.
Lisa?
Get out.
Hey guys, great to catch up with you. Greg Staples, Lisa Hornby, Ken Monaghan from New York City. That does it for me, for our audience worldwide. We'll see you next Friday, 1 p.m. New York time, 6 p.m. in London. This was Bloomberg Real Yield. This is Bloomberg TV.